Hey everyone, welcome. Good to see you guys. Sorry I'm a few seconds late. Not too bad, but I'll probably wait a few seconds here or a minute to let people get in, and we'll take a look at what happened in the markets. So let's take a look actually, SPY, and not too surprising. What have we been saying? We've been saying that, hey, we're probably, we're a little too high away from the EMA 8 and the EMA 20 for comfort. We're probably going to start pulling back soon. That hasn't happened yesterday or today or Friday, but at least we're just chopping sideways. And that's not unexpected because of the FOMC minutes, or not the minutes, the rate cut decision that's going to happen tomorrow. Hi, Lise. Good to see you. Scuba Chris. Nathan. Oh, I haven't seen you in a while, Nathan. Good to see you. All right. And James. Hey, John. Good to see you guys. All right. So more chop today, and that's not surprising because of the FOMC rate cut decision that's happening tomorrow. Now, there's really not going to be any surprises. It'd be very unlikely that there's going to be any surprises. Right now, the Fed rate is projected to be just 100% chance that there's going to be a rate cut. 96.1% that it'll be 25 basis points, and a 3.9% chance that it'll be 50 basis points. So 50, very, 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 very unlikely. If we do get that 50, we'll probably see a run upwards. If we only get the 25, you'll see a bunch of volatility, and it's a little uncertain exactly what direction that will take the market if all we get is exactly what we expected. What should happen, what normally happens, if the market gets exactly what is expected, then what happens is the normal market rhythm continues. And the normal market rhythm at this point in time would be a pullback to the EMA 8 or EMA 20. And so people will be like, oh, they cut rates and we still fell. And then people will make a big deal about that, but it won't be a big deal. It just means the market got what is expected, so it's going to behave as expected. And how is that expected? Or for us, who understand the normal rhythms and movements of the market, it would be a pullback to the EMA 8 and EMA 20, simply because we're just a little bit overextended at this point in time. So don't be surprised if we get that 25 basis point rate cut and we move downwards. There might be volatility first. We might head upwards first, but within a day or two or three, we're probably going to start pulling back towards that EMA 8, or more likely at this point, that EMA 20. The reason why I say it's more likely to the EMA 20 is actually probably more obvious on the SPX. Hey, on the SPX, I drew this line already at 6,500, and that was a really important point for several weeks in the market. You can see it, that we touched or came close to touching it many, many times ever since beginning of August. So over a month now, we've been targeting the 6,500, and it was in focus as a gamma level since before that, since probably I said beginning of August earlier, I meant mid-August, August 13th right here. But since the beginning of August, we were actually looking at that level. It showed up on the gamma levels. Right now, we are seeing gamma levels all the way up to 7,000. But again, it's not going to go straight there, just like it didn't go straight to 6,500 when it was in focus. We did have a little bit of dip, and then we hit that 6,500 over a couple of weeks. So same thing here. We're probably going to see that dip and then go up, not to 7,000. There are gamma levels between here and 7,000. 7,000 is sort of what I'm at this point in time expecting by the end of the year. So about 3 months from now is we could possibly hit 7,000. We do need to pull back at least once or twice on our way to 7,000. But for now, immediately after the rate cut, I am expecting a pullback. Again, not necessarily immediately, but probably soon after that. Now, traditionally, or at least historically, I should say, not traditionally, after a rate cut that happens at or near the all-time highs, which we are at right now, what we see is that in the next 3 months, or next 1 month, I should say, 30 days, the 50-50 shot as to whether or not the market is higher or lower than the day of the rate cut. But over the next 12 months, it's pretty close to 100%. I don't know the exact percentage, but it's in the high 80s or 90s, where every time we've had a rate cut near the top of an all-time high, or near an all-time high, I should say, then 12 months later, then we're higher than where we were in that rate cut cycle. Okay, so this is a rate cut at this point in time is short-term bullish, not guaranteed in the immediate term, like a 1 month term, but in the next 12 months, it is fairly bullish for the markets. And that is just what we're looking for. And there's expected to be more rate cuts this year, right? We're still pricing in 75 basis points worth of rate cuts by the end of the year. Let's just see that over here in the December. Okay, you see that? From where we are, this would be 25 basis points, 50 basis points, 75 basis points. So at this point in time, by December, the market is still projecting that there's going to be 3 rate cuts, or at least 75 basis points worth of rate cuts by the end of the year. So the fact that we're at all-time highs, we are totally expected to get a rate cut. If we don't get a rate cut, you can expect a giant tumble from here. Okay, so I don't think that's going to happen. I think we are going to get that 25 basis point rate cut. And if we get that, the market is expecting another and another by the end of the year. And for all of those reasons, we should still positively expect that we can hit 7,000 or kind of close to 7,000 by the end of the year. And some people have emailed me and said, Kane, I'm worried about this market. I'm looking at the jobs. I'm looking at this. I'm looking at all these different things. And it appears to be negative. And the answer is yes. It does appear to be negative, but everything that you're looking at is data about the economy, and the economy is not the market. And the market will do whatever it wants to do until it decides to do something different. So what that means is right now, what is the market doing? It's doing whatever it wants to do. It's doing this. And instead of trying to use data and anticipate that the market, I'm having a difficult time with this. There we go. Okay. That's what the market's doing right now. That is what it's doing. And until we see, or I see, positive confirmation that it has decided to not do that anymore, then I'm going to go with what it's doing. So what that means is it would look something like this. If I'm following a shorter term, right, if I'm using my 50 as my longer term, and then my 8 as my shorter term, okay, just like I always talk about in the post-market review or live stream, that's what that has looked like. And so that has looked like buy, 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 buy. And we're still, right now it's hold. We haven't reached another buy point yet. Okay, so I would have been right 1, 2, 3, 4, 5 times so far. And then it might do this. And from here, it'll either do this or it will do this. Okay. But according to me, and according to our everything that our approach to the markets, okay, it might also do this. Okay, and it might also do this. Come on. Okay, so what this tells me is that I shouldn't be worried about an imminent bear market. Why? Because it could bounce off of that EMA 20 and then go up. It could bounce off of the MA 50, then go up. It could bounce off the MA 200 and then go up. Okay, the only way that we turn into a bear market is if it breaks every single one of those. So basically, there's only one path to a bear market, And there's 3 or 4 paths to a continuation of the bull market. It's just how deep of a pullback we get before that continuation. So the odds are, the probabilities are still that this market is going to continue upwards into the end of the year. And therefore, I'm going to stay bullish. I'm going to stay bullish until I'm proven to have broken one of these. And the most important one that I'm focused on is this one right here. So basically the MA50, okay? So if we break the MA50, because there is enough of a distance between the MA50 and the MA200, that I can go short-term bearish to the MA200 and still be long-term bullish in the market. But that's enough distance for me to get some really good shorts in. Okay? The distance between the EMA8, where we are, and the EMA8 and the EMA20, that's not enough to get me a good short. If we distance between now and the MA50, that is maybe enough to maybe sort of get a good short in. But that's not guaranteed, okay? So that's still taking a little bit of risk, so I wouldn't do that. I would still maintain longs. If we break that 150 and there's still that big distance between the MA50 and MA200, then yeah, I can short-term pick up some shorts and then see if it bounces off the MA200. Okay, so what all of this tells me is that at this moment in time, the fact that we're at an all-time high and there are many multiple paths to maintain bullishness and only one, and you might argue 2 paths to take bearish positions, well, that means I'm going to maintain bullish positions. Okay, so my view needs to be on the market and not on economies, not on data, not anticipation, not I'm afraid that this will happen or this will happen. Because if we were afraid, we were already over here, like, oh my God, we're at all-time highs. The valuations are too high. Right now, the valuations of the S&P 500 companies are higher than the dot-com era. Whatever other argument you want to make, fine. Then you would have missed all of this upside right here. You would have missed this buy, this buy, this buy, and that buy. The last 4 buying opportunities you would have missed. And you would have been wrong this entire time, and you would have been either on the sidelines making no money or trying to go short and just getting your butt handed to you by the market this entire time. Okay, so we want to take our cues from the market and not from data or projections made off of data. We just want to watch this market actually break this trend line or break that MA50 before we even begin considering shorts inside of the market. What that means is, okay, what if it does break, Kane? Then you're wrong. You lose this trade. Yes, you're absolutely right. I never expect that I'm going to win every single trade. And I never expect that I'm not going to lose. But guess what? I won and I won and I won and I won and I won. And if this is the one that breaks, then I lost that one. I won 5, 6, 7 times before I lost the one. And if I have better than one reward risk ratios, or at least 1-to-1 reward risk ratios, I'm doing really, really well. I am willing to lose every once in a while. Okay, so this gives me my best chance. Okay, so because it could bounce right here, bounce right here, it could bounce right here. Forget about this one, I guess. There's 2 chances of me bouncing right here, one of going down. That's still better odds that it will continue upwards. Okay, so if I enter on this bounce, I might be wrong, or I might be right. If I enter on this bounce, okay, sorry, I should say this again. If I enter on this bounce, I could be right immediately, or I could be temporarily wrong and it bounces off of this one, the MA50, and I'm still right. I'm still okay. I still make money. And then if I'm wrong about that, then we break down. Then I lose. Okay, fine. I had 1 out of 3 chances of making money over here, and that was the one that I lost money on. But I made money over here and over here and over here and over here and over here. So net, I'm still good. Okay, and once I recognize that I'm wrong, then this won't go straight down to the MA200. It will. Oh, it'll do stuff like this. It'll go break and then go to the MA100 and then go up like this. And then probably at least once or twice before it reaches that MA200. So I can be wrong right here, make up for it right here, or right here, and then make up for it again right here. So it'll balance out, it'll even out. I'll win more often than I lose, and that's what I need, okay? So we don't anticipate, I don't anticipate. We just take whatever the market is giving us. Okay, let's see. Hey, C. Fazio, you're very welcome. Hey, Peter, dot plot for projection will move things the most. Do you agree? I think the statements, whatever Powell says, will move things the most. The dot plot, I think at this point in time, we sort of know what the dot plot is going to look like. If there are surprises in the dot plot, then yes, absolutely, that'll move things more than any comments. But if the dot plot comes in basically supporting this exact same idea right here, then it's not going to have much of an effect. Then it'll be a very, very careful discernment of what Powell says, the words that come out of his mouth. Is it because things are already priced into the market? Yes. So whatever is expected, the most expected, that is already priced into the market. So you'll see volatility, but you won't see a big directional move because of that news. The market will just resume whatever it was going to do as if there was no news event. Hey, Marlon, good to see you. Are we expecting SPY to pull down in the morning? Not necessarily. I'm not really expecting too much movement, actually, until we actually get the announcement, which is 11 a.m. my time, 2 p.m. Eastern. So basically, I'm sorry. Yeah, 11 a.m., 2 p.m. Eastern. So basically 2 hours before the market. So all the way until that time, I don't expect a lot of directional movement. We're just going to be floating around because no one is going to want to make big bets. Right? So even day traders are probably going to have a hard time because there's not going to be a lot of momentum or directional movement. So it'll be hard to pick off some day trades. Otherwise, your reward risk ratios could be really off because you're trying to chase small movements and they could go against you. A small movement against you already messes up your reward risk ratios. So most likely, you're not going to see a lot of activity in the morning. And then generally, no matter what, even if it's exactly what we expected, we generally do get sadly some increase in volatility immediately at the rate cut, and then more volatility when Powell starts speaking. And then depending on what he says, it may go directional one way or the other. Okay. Looking at the monthly chart, nothing plans to slow down if we look at the monthly. Yeah. And so monthly, you're going to react a lot more slowly, but it's the exact same idea. So if you look at the monthly, that is like strongly bullish. And then you would see, hey, does it pull back to that EMA 20? Does it pull back to the MA 50? But it has to pull back. It has to break many, many levels before we consider this thing bearish. And for the monthly chart, I would use the MA 50. Otherwise, I mean, you're going to wait forever on the 200, right? How many times have we broken the 200 since the beginning, right? So basically, right, never. You can't say this because the MA 200 didn't exist yet, right? So that doesn't count because the MA 200 didn't exist yet. We have never broken since the beginning, since 2009, since we have enough data, 200 months worth of data in order to build this thing since 1993. It's never broken that MA 200. So MA 200 on the monthly chart is not very helpful. And it looks like the MA 50 even is not very helpful because how many times have we broken that? This one, it didn't even last 1 month. And so that was the only time. So you gotta be careful with the trends trying to read the trend on the monthly chart because it'll be deceiving. Because you say, oh, well, it's never going to slow down. Yeah, okay, well, do we count this? Because that just, oh yeah, it's not slowing down. That's just a normal pattern. So we can be amazingly bullish, very, very long term on the US stock market for a lot of reasons. Why? And this is why people love investing in the US. The entire world loves investing in the US stock market because of this phenomenon. And there's there's 4 main reasons why this happens. One, continued growth in GDP, expected growth in GDP, continued positive population growth, and then the rebalancing of the indices. So SPY, the S&P 500, the weak stocks go away, they leave the S&P 500, and newer, stronger stocks enter the S&P 500, and it is market cap weighted. So all of those 4 things show us that basically the S&P 500 will continue to go up until or it's we can say that there is pretty much a guarantee that it will keep on going up until one of those things is violated. And when one of those things is violated, doesn't mean it won't go up anymore. It just means it's not guaranteed anymore. Just like the Japanese stock market, it was dead for decades until somewhat recently, last couple of years, because they don't have a growing population. They've had a shrinking population for decades now. So that is one reason why we can't guarantee that the Nikkei is going to have this type of pattern. Okay, so we want to be careful when reading that monthly chart because it always looks bullish on the S&P 500 at least. So if you're if you're saying, hey, put my kids' savings into this thing and into when they grow old, everything's going to be peachy, then yeah, I agree with you. It's just plain bullish, and we don't see anything different. But if you're trying to time this and say, hey, we're about to go into a recession, this isn't going to help you at all. Maybe the weekly would do a little bit better, but even so, you can see even the weekly is not, right? It's just, there's no, for 4 weeks right here, that's the same 1 month dip that we saw earlier. That's the only time it pierced that MA 200. So in terms of looking for recessionary dips for bear markets, the daily is my personal preferred time frame of choice for precisely that reason. You're never going to see it on a weekly or a monthly chart. Let's see. Looking forward to seeing tomorrow on the Gex Master. Oh, me too. Thank you, Tim. Yeah, I'm looking forward to showcase and teach you guys exactly how to use it. Hi, Phil. Hey, Tristan. Love the masterclass. Oh, great. Thank you. Good. I'm glad you're getting value out of that. Any stock we need to keep an eye on? That's a good question, and I would not do anything personally. I don't know if you guys saw on my Telegram channel, I made a note. It's like, hey, why hasn't Kane issued any trade alerts the last 2 days? And the answer is because I'm taking profits. We're at all-time highs in the market. I'm taking profits before the FOMC announcement because there's a lot more likelihood that we are at least going to mean revert than we are going to go screaming higher. And so I don't want to initiate any new positions in that type of environment, especially high volatility environment immediately after the FOMC announcement. So it doesn't make sense for me to initiate new positions, whether they're longs or shorts at this particular point in time. Why do I not want to issue shorts? Because again, this tiny pullback to the EMA 20 is not enough for me to get enough juice in a short, unless I'm trading, overnight trade or 2-day trade or a day trade. So I've been busy taking positions off, even if they haven't hit my price target yet. If I plan to only hold it for within, say, by next week, next Friday, or the Friday after that, I'm already just going to take the profits, and that might be a good policy to adopt tomorrow morning as well, because the FOMC, that's volatility, and we don't know which direction for sure that is going to go. Just that a little bit more likely that it's going to go down. And again, I don't want to initiate any new shorts off of that, but I definitely don't want to initiate any longs when I think that things could very likely go down. So it's time for cleaning up the portfolio, taking profits, having more of my portfolios in cash. And that way, after all that volatility subsides and I can see exactly where the market is going to go again, then that's when I start deploying capital. That's when I have a high probability. Right now is a little bit of a crapshoot. Right now it's a little bit of a gamble because of the FOMC could drastically change. It is one of the few things that could drastically change the course of the market by itself. It's very rare that there's something that can do that. But this rate cut definitely has the possibility of saying, oops, we're not bullish anymore. We're going to turn very bearish. I got that completely mixed up on both ends of getting that sentence out. We could turn very bearish if the FOMC, if the Fed decide that it's not going to cut rates. If we cut 50, that is a little bit of a crapshoot. It's about 50-50. Well, actually a little bit. It's like 70-30. Okay, most likely it's going to go up, but 30% chance that there's going to go down because it could be interpreted as the Fed is really worried about something bad happening and like, oh, do they know something we don't know? Okay. And for sure, if they do 75 basis points, then everyone's going to freak out and like, why the heck are they cutting 75? Things must be really bad, way worse than what we thought. And then that's going to send things tumbling down. So either we get a no cut or a rate hike or too much of a cut, that could all send things downwards. But right now, realistically, the probability, again, is overwhelmingly that we're going to get a 25 basis point rate cut. So I'm not really worried about any of those scenarios. I'm just saying it makes sense to be more in cash now than in a lot of longs. And soon, once we get that pullback to the EMA 8 at the very least, but I'm looking more for a pullback to the EMA 20 before I start initiating longs again. And I will not initiate any shorts unless we're below that MA 50 or I have a portfolio that needs to be balanced. I have 20 longs and 0 shorts, and we are at this point in the market. It doesn't make sense for me to be that bullish. Okay, so I need to get things back into cash, or I need shorts to offset all of those longs in case of something crazy happens. Like I said, what if they cut by 100 basis points? And the market gets shocked and like, oh my God, why are they cutting it so much? Well, we need to panic because they see something that we don't, and then we start tumbling downwards. Well, then my super long portfolio is going to be screwed, right? So it makes sense to have a lot more cash right now in this particular today, tomorrow, or balance out my longs with some shorts, right? But other than that, I'm not going to have any shorts, and I don't want too many longs right now. Okay, so I want some longs because there's a reasonable chance that it could just float up from here. I could be wrong about it pulling back right now at this particular moment in time, about the timing of it. I could be wrong about the timing of it. And so, yeah, I want to have some longs, but just not a lot of longs. Okay, let's see. It seems it glides on the MA50. SMA, I believe you're talking about the weekly and or the monthly chart, and yeah, we do bounce off the MA50. Yes. If you get a chance, can you let us when it's 1-to-1 or 2-to-1? Rob, are you talking about actual official trade alerts or examples that I give you? Because I think I pretty much always, not always, but often give you the reward risk ratio when I'm doing demonstrations on the post-market review. The trade alerts, I mean, I guess I could, but so here, trade alerts they're a little bit of a tricky beast because I have to do all the analysis. I always do all the analysis no matter what. But then I have to get the trade alert out in a timely manner. So somehow I either have to be able to download all of that analysis to you guys and then give you the trade alert, or I just issue the trade alert. And any additional detail slows me down, which means that the opportunity could move by, it can move past you guys and then be like, hey, we didn't get the trade alert in time. You said to get in at $5 and it's already $5.50. And we got all sorts of those problems. The longer I delay between I'm done with my analysis and I actually get the trade alert out. So it's always a balancing act. Like the gamma pockets, I used to always do a full on write up and give you exact trade, like every single detail. But to put out that report, sometimes it delayed my trade alert by 30 minutes or even an hour and a half, depending on all of the detail that I had to get out. So I tried recording videos, but then no one was really watching the videos, and it was taking me a long time, 10, 20 minutes to create the video. And so that became like kind of pointless. And so I started putting less data in my trade alerts. Okay, so I always have this balancing act between how much detail I give you and how timely that trade alert becomes. So can I put the reward risk ratio? I can experiment with it and see how much it slows me down. We'll just have to see. Okay. Rough day for Duke. Took that trade last week. Yeah, it did. I did a nice bounce over here, and then unfortunately today, in one day, it kind of undid all of that, didn't it? That is a little bit rough. And according to this particular trade that I guess I demoed 2 days ago, then you would stop out at this point in time. But if you entered over here, like closer to bounce off of that trend line, then your stop would be more like over here at the 120-ish level or 119.5 level. Yeah, that's unfortunate. Everything was setting up to look really great, and then who knows what happened with Duke today. But it happens. We don't win every single trade. And the gamma pocket, we can see if it's still there. So here's what I do in this instance. Follow your plan. If your stop loss is right here, your stop loss right here, out. It's time to get out. But if you say, hey, there's still a gamma pocket up here and I still like it, then what you do is you wait for your opportunity to get back into the trade. You absolutely stop out now, and then you wait for a high probability entry to get back into the trade. So let me see if I can see if that gamma pocket is still there. Okay, so there is a gamma pocket right here at 125. It's still there. And a little bit of support right here at 115, but we're already down to we're at 120.25. We don't have support at 120. Interesting. You will have a little bit of support at this zero gamma line. Okay, so there is some support right here at 117 and change, which is, oh, that's too far. That's way too far. That's all the way down by the MA200. Yeah, that's too far. Okay, so this is what we do. The gamma pocket is still there. It is still the overwhelming gamma pocket. And then above it, 130 is possible. If it can get past 125, it can still get to 130, possibly. And so now that this trade has failed, so let me erase everything. Okay, so that trade failed. If it bounces at 120, pretty close to where we are right now, if it bounces at 120 or close to it, right? So basically anywhere from where we are right now down to about 119.70. Why 119.70? That was the low of this line right here, which is a nearby level. And then wherever we are right here, okay? So what I'm looking for is bounce or okay, bounce or bounce from any of these levels. If we get a bounce, then that would be a good probable trade as well. I wouldn't necessarily target 125. My gamma pocket is at 125. However, I now have resistance in between. I now have the MA50 as resistance, the EMA8, EMA20. I have all that resistance. I also have this horizontal right here, okay? So you could then say, okay, if it bounces, then I'm going to do a short-term long all the way up to here, okay? And then I could also say, if it then bounces and breaks out, so just say it came down, and then it breaks out of the MA50, EMA8, and EMA20, then I'm going to start targeting that 125 again. Okay, so I have a short-term trade right here. If it bounces from these levels up to the MA50, and then if it breaks out, I do another trade, a breakout trade up to the 125. And that's how I continue to play Duke. But right now, I absolutely close out that trade. I follow my plan. I take the loss. I don't say, I'm going to remedy this. I'm going to fix this. I'm going to move this and that. I'm going to roll this. I'm going to move my stop loss. No, none of that stuff. It was a loss, plain and simple, period. We had a huge unexpected down day on Duke, and we took a loss. It went against our probabilities. It did something we completely didn't expect, and therefore we should lose. So we didn't, well, we did plan for that. We just didn't think it would happen, okay? Our plan was to stop out if it went below that VWAP right there, and that's what it did. So we should follow our plan and get out, but we might have opportunities soon for a short-term trade and then a breakout trade that targets the 125 again. Right? So that's how how professionally you would take a look at a trade like this and say, okay, well, yeah, we take the loss. There will be another opportunity. Either I'll have an allocation available for it at this point in time, or there was a better opportunity when this happens, and my cash was better served going to a different trade at this particular moment, either this moment in time or this moment in time. Okay. How can I take advantage of mornings when you share the SPX levels with us via Telegram? There's a kind of a little art to it, Omar, but basically, yeah, those levels that I share with you, those are important levels. So like today, when it's a little bit less clear cut, when you don't have a pin, it's a range, right? So this range was from 659 to 662. That's what I said in my alert. And those are the two largest negative and positive gamma levels. If the largest gamma level was this big versus the largest positive, then I wouldn't care about the downside. But because these are similar in size, yeah, I care about both, 559, 662. And when did I issue that? That was at 7:06 a.m. So over here on SPY or SPX, okay, at 7:02, okay, at 7:02, I gave you, oops, 661, and I gave you 659. Okay, and it did perfectly stay in that range, and we ended at 660, kind of basically right in the middle of that range. So there's a couple ways that you can play this. If I don't give you an exact level, like one level, if I give you a range, you're probably better off doing a non-directional trade, and in this case, a butterfly. If there's a clear spike somewhere, if there's a reason to be more biased to the upper one versus the lower one, or vice versa, then you could do a butterfly. But at 7:06, you could have done an iron condor at these two, and then you would have made maximum profit, whatever that was. It was probably, if I remember correctly, you probably could have gotten maybe like 30 cents for it, for a $1 wide spread. Okay, so 30 on 70 cents of risk. Okay, that's about 40% gain that you could get from that. Okay, maybe it's only a 30% gain, maybe it's only 20% gain. It just depends on the day and the volatility that day. But that is one way that you could do it when you get a range like this. The other thing that you could do is say, okay, well, I've got this 559. When this price gets close to this line right here, this line is a 2 standard deviation away from the VWAP, okay? And we do have a tendency to revert. It's not a guarantee, but we have a tendency to revert at or near that 2 standard deviation line. Here went through a little bit, but it ended up going back. Okay, here it reverted, and then it reverted here. Here it's stuck with the 2 standard deviation for quite some time before reverting and bouncing and reverting off of that one. Okay, so but those are pretty good areas where the market often will turn back around and head in the other direction. No guarantees like here. It stuck with it for a very long time, but eventually it did revert. And let me see if I can find an example. Okay, here, hit it, reverted, ended up even higher because this thing expanded. So it did end up going back up above this point where it reverted. But by then, that line has expanded way up here, so we're well within those bounds. And then there are times where, see, and just because it reverts doesn't mean it doesn't end up lower, right? Just because it reverts doesn't mean it doesn't end up higher. It's just saying at that moment in time, it might revert. Okay, so you have to be aware of that. So if it's a directional day, then I'm not necessarily going to look for that reversion, okay? So I'm talking about non-directional days right now. Because if it's a directional day and it does revert off of that 2 standard deviation, you could still end up further than where you reverted from, just like this. Yes, it did revert off of that 2 standard deviation, but we ended up way lower than this point right here. At least for a long time we did. At the very end of the day, on this day, it just happened to trade back up, but it could very easily not have, okay? So on a day like this, where we're just expecting to chop sideways and go nowhere, then as we got near this 2 standard deviation point, and we see it start to bounce a little bit, like either at this point or at this point, I could have bought a call, or I could have done a bull call vertical debit spread, or a credit a bull put credit spread if that's your preference, but I prefer debit spreads. So I could buy a 0 DTE call spread right here, or I could just buy a simple call at any one of these points and then just watch it trade back up to the VWAP. Okay. If I bought the vertical, I may consider holding it all the way to the end of the day. And do I buy the vertical right at this price, or do I buy the 659, 658 vertical? That depends on your risk preference and your risk tolerance. Personally, 0 DTE, and I don't want to manage the trade. I don't want to stare at this thing all day long because I have a lot of other things to do. I have a lot of other trades that I need to look at and members that I need to take care of. So personally, if I did the trade, I would be doing the safer trade at 659. So let's just say at this point in time, you saw that we got very close to that 2 standard deviation point and then started to revert upwards. Then what I would have done was I would put a 659, 658. So sell 659, buy 658, call 0 DTE, call debit spread. And that I probably would have only gotten, I probably would have paid maybe around 80 cents for that, given on the time of day that it was, 80 to 85 cents. So I'm taking a little bit of a larger risk right there. But I could do that, and then it would have worked out very well for me. I would have gotten the full profit on that as well. And then the other thing you could have done is at the 661, if we ever got close to that, which we didn't. So, but if we did, you could have done the opposite. You could have bought puts or done the debit put spread and traded to the downside. So there's all different ways that you could capitalize on the 0 DT information that I gave you today. Okay. Let's see. What percentage of correct predictions have you measured since you've been sending it to us? I think you're talking about the SPX, SPY. I haven't kept track, but just anecdotally and just from gut feel, there's been plenty of weeks where it's been spot on all 5 days of the week, or it's pretty much spot on for 4 out of the 5 days of the week. So I would say at least 80%, if not 90%. I would say but that's a guess, right? I don't keep track of that. When you say back into cash, what percent do you want in cash? I don't have an exact percentage. For me, it is the way I think about it is, if all my longs suddenly go to 0 at the same time because of a black swan event, how much does that hurt my portfolio? Am I okay with it? Okay, so if I have if my answer is I have so many longs on right now that I lose half my portfolio, I'm not okay with that. Okay, so I'm going to offload all the ones that are pretty close to their profit target. Those are the ones that I'm going to offload first, and then And then I'll recalculate if all the ones that I have left over, if I lose all of that because I'm expecting volatility in the markets, then how much does that hurt my portfolio? And if I'm still not happy with the number, then I start paring down ones that are still somewhat close to their profit target, not as close as the ones that I already liquidated. And then depending on how far away from the target it is, then I'll liquidate. Or if I have some that are in a little bit of a loss, like, oh, you know what? I can just cut these losses at a very small percentage, like 5% loss, versus taking the risk that it could have just hit my entire stop loss. Then I'll just close out those ones as well, and then I'll go back and I'll look. At some point I'm going to be at a point where if all of these go to zero, I'm okay, and that's where I stop, or not necessarily where I stop. Sorry. Or I could keep on going. It just depends on what I'm not managing this to my cash. I'm managing it to the volatility event. Okay, so if I have positions that can withstand the volatility, then I don't care. I'm expecting to hold this thing to December. I'm expecting to hold this thing till November. I don't care about the short-term volatility. Okay, but if I'm holding it only, I'm expecting to close it this Friday. Well, that's only 2 days after the volatility event. Well, or next Friday, that's only 1 week after the volatility event. So for sure, those ones I want to take off the table, whether they're in profit or in loss. For the GEX masterclass, I think you mean the trading terminal. Will there be any alternative price plans with less things included? That is up to the publisher. I don't know, but I think there's two versions. There's the VIP version, which you get if you buy unlimited access, and then there's the scanner, like the scanner version, which is what you get in a normal membership. And those are the only levels that I know of. Today's candle range could be an inside trading range. For Duke, yes, it could. It could just kind of float around over here. In which case you don't want to be in there unless you're in a vertical or some sort of spread that takes advantage of time decay. Then you wouldn't want to be in Duke anymore, anyways. Hit my stop alert. I'm going to exit in the morning. Expiration is Friday. Yeah. So that's a good idea for Duke. Scuba Chris, what did okay, yeah, I answered that cash question. How many open positions do you have in normal market conditions? I am not your normal trader, and my account, it depends on my account, okay? If I'm trading a small-ish or smaller account, just say if I'm trading something under 50,000 or 100,000, then the most I will have is 5 longs, 5 shorts. Okay, so 10 positions at a time. Because they eat up your allocation, right? It's when you have less than 100,000 or 50,000, each position is a significant portion of your allocation, of your portfolio. So 10 is already way more than enough. Most likely you won't even hit 10, but if in any one direction, I'm only going to have 5. So I'll have 5 longs and 0 shorts if I'm super bullish. If I'm less bullish, I might be 3 longs and no shorts, or 1 long or 2, or 1 long if I'm very mildly bullish. If I'm neutral, then I'm always going to balance them, 1 long, 1 short, 1 long, 1 short, up to 5 of them. If I'm mildly bullish, then I might go 3 longs, 1 short, 4 longs, 2 shorts, something like that. Okay, and then vice versa. If I'm bearish or slightly bearish, then I'm only going to have 1 or 2 bearish positions, or I could have 3 or 4 or 5 bearish positions and 1 or 2 or 3 long positions. Okay, so 5 and 5 is only if I'm neutral on the market. So most likely I'm not. or at least lately I haven't been, right? I've been bullish on the market lately. So I've had 1, 2, or 3 or 4 longs. If I have 4 or 5 longs, then I have balanced it with shorts, but I haven't been doing that lately. So I've had like 2 or 3, sometimes 4 longs on at the same time in accounts that are 100,000 and less. For ones that are above that, then I can do a lot of positions, 40, 50 positions sometimes. I don't like to do that because I don't like to spend all my time managing portfolios anymore. In this stage of my life, I don't really enjoy doing that. So normally I will have a lot fewer positions, but my rule of thumb is I have to be able to remember the trade. So if there's so many trades that I can't remember them anymore, I'm doing too many trades. I have to be able to fit them in my head and be familiar with them and say, okay, and what about this trade? And it's like, okay, I know why I went into the trade without looking at anything. I know I'm in the trade. I know if I'm long or short, if I'm bullish or bearish. I know why I entered the trade. I may or may not know my exact target, exit, or loss, but the second I open a chart, I would be able to know it very immediately. And most likely, I'm going to also remember the exact option that I chose in order to get in. Okay. If I can't do that, I have too many positions. I'm going to struggle with the management because I always have to look up everything. How's this trade doing? I don't know. I have to look everything up. That slows me way down. So I have to be able to remember the major details of the trade. And for me, that is roughly 40-ish positions. That's probably too much for most people because I did it for many years. I trained. I have years of conditioning myself to be able to remember that many positions. So most people won't be able to do that. So I would say probably 10 is most people's limit without a lot of training and getting used to managing that size of a position. Okay. Thank you. Good to know it's a risk tolerance rather than cash percentage. Yes, yeah, absolutely. F20 will be trimming. Okay, Dan. All right. Well, if you can remember all 20, right, and you can just know exactly how you're positioned on all of them, then no problem. Or if you don't mind, like looking everything up, managing it, looking after that management, if that's not too slow for you, and like you can react to the market in time doing that up, then you're okay. But for me, I like to be able to respond very quickly if something is going on in the markets. You did write every detail of the trade position and tracked in Thinkorswim and options. Great. Yeah. I write every single detail. I print everything out. I print a chart. I draw on the chart exactly why and what my trading plan is. I write out all the details. I know my max loss, my max gain, my reward risk ratio, my entry point, my target, my exit. My entire plan is written out on that. And then every day I review every single trade. Okay, so all the trades are fresh in my mind and I can recall very easily, very quickly. And so if anything's happening in the markets, then I know, okay, I better check on these trades over here because those are the ones that are long, or these over here because they're verticals and they'll be affected more by this, or these are singles and so they'll be affected more than the verticals because the verticals also have time decay and they don't care as much, or whatever it is that's going on in the markets. I can pretty much immediately go to the subset of trades that I need to check on very quickly and make a decision, or say, and that's if I think the trading plan needs to be revised. If I don't think the trading plan might need to be revised, then I can quickly check out, did this market event put me through below my stop or at my target? Right, so the ones that I was talking about a little earlier, this is important distinction, and I'm glad we got to this. But it's if there's always an underlying assumption, whether you explicitly write it out or not, or you know about it in your head or not, that if I'm long Duke right here, then I'm long energy. And so there's an underlying assumption that energy is still doing well. Right? If I'm long an S&P 500 stock, or any large cap stock, even if it's not an S&P 500, then there's an underlying there's an underlying assumption that the SPY is still bullish. If some sort of market event causes me to be bearish on the S&P 500, then every single one of those trading plans is now invalidated. I need to go back and review them. Do I need to scratch this trade? Do I need to close out of this trade, even though it didn't hit my stop loss? Do I need to get out of this trade because my underlying assumptions are now dead? Or does this plan still survive without that one underlying assumption that just got violated? Okay. So at the very least, it's going to require almost always a modification of my trading plan. Okay. So in a less advanced environment, when I was less advanced of a trader, I would just close out everything. Oh, violated that assumption, out, done. So for example, COVID, right? If we're in COVID, bullish, 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 bunch of bullish trades, boom. Gap down below the MA50. Uh-oh. We just violated this. Okay? So it doesn't matter if I was trading because of this and I entered over here. We just violated this. So all of my trades, all of my longs that were based on that we had a long-term trend in the direction of the MA50, all of those just got violated. Close all the trades. If you had done that, then you would have avoided this during COVID, okay? And then actually I did that. And then what I actually did is I put on one short because of the distance between the MA50 and the MA200, just like I talked about earlier today. And I also put on a volatility trade, a long on VIX. And then we ended up doing this, okay? So I actually did quite well during COVID. I had several positions that I made over 800% on, and a few positions I made over 2,000%. Why? Because I recognized immediately that one of my underlying assumptions just got violated, and that invalidated every single long that I had in the market at that point in time. Okay? Took the loss. Day one, took the loss. Why? My underlying assumptions got violated. Okay? I didn't even bother trying, do I need to fix my trading plan? No. The underlying assumptions are wrong. That means everything that you plan for is false. It's wrong. So if I really, whatever reason, really like that trade for whatever reason, like, oh my God, like 499 stocks out of the S&P 500 gap down like this, and one stayed flat or just went down a baby amount, then I might be, okay, wow, this thing has incredibly strong relative strength, and maybe I'll modify my trading plan to stay in that position and just keep it long. Maybe, okay, if that had happened, but that's not what happened. Every single stock was down. So all 500 of them, not just 499 of them. But underlying assumptions violated. And even if my stocks did not hit their stop loss on that first move down, I cut them because my underlying assumption was violated. Okay, and that saved my butt during COVID. Because if I held on to anyone, all of them would have been lost 100% if I had held on to them. Okay, so that saved my butt right there. And then recognizing that, hey, maybe I have an opportunity for a short down to the MA200. That made me some money. And then when we violated the MA200, especially when we bounced back and retested it and then came down, this is where I made a whole bunch more money. Okay, but I could only make that money because I was first willing to take this loss right here. Okay, that freed up my capital. Yes, I took a loss, but now I have cash. And if I have cash, I can take advantage of this stuff. If I don't have cash and I'm sitting there hoping on my longs, then I'm just losing money hand over fist on the way down. Okay. So, so it's important. If you violate your root assumptions, the ones about the market, the ones about the sector, right? The ones about the trend in the market, the ones about the trend in your sector. If you violate those things, your trade is invalidated, right? Even if your stock hasn't hit its stop loss yet. So very important, very, very important. Okay. I know no one can predict the future, but when do you think there will be a sharp market crash next? Like March, April 2025. I'd like to try a lot of 0DT contracts with SPX puts. Well, again, I would just watch and wait for it to happen, right? And what would that look like? Well, you identified a couple places already. March, April 25th, right? How would you know? One, violation of a key level. On this day, you could have made a lot of money on puts. Okay, violation of that MA200. Okay, retest and fail of that MA200. Okay, retest MA200 and it's stuck. Not a great day to trade it. So let's look at March 24th. Let's look at March 10th. Let me write these down. 310, 324, 325, 326. Okay, and this will be the last question because we're running out of time. Okay. Very helpful. Good, good. You're welcome, Dan. You're welcome, Chris. What are the indicators that you use? I didn't. I just told you all the indicators I use. MA violation of the MA50, when like the sudden violation of the MA50 when everything was looking bullish immediately beforehand. Okay. So just simple trends and I'm not a big proponent of indicators. You may have noticed that every time I talk about in the post-market review, it's always levels, gamma levels, long-term, short-term reverting to the long-term, okay, MA50, EMA20, EMA8, MA200. That's all you ever hear me talk about. You don't hear me talk about any other AVWAP sometimes, okay? That's all I use. I don't use any other indicators except for Maverick. If I'm trading specifically Maverick trades, then or Maverick related trades, then I'll use Maverick, my own proprietary indicator. But other than that, I don't really use ATR. If you consider ATR an indicator, it's really not. It's just the true range is a measure of randomness. Okay, that's about it. Okay. All right. So let's look at these dates real fast, and then we'll wrap up. So let's go to a 5-minute chart, and we are going to March 10th. Okay, so where's March 10th? We didn't go to March. Oh, it won't. Will it let me? What is this? September? No, it won't let me on a. Will it? I don't think so. 30-minute chart? Can I go to March 10th? March 10th. Okay. I need to remove all of these moving averages. Okay. March 10th. Gap down. Okay. And what I see the previous day is that we already trended downwards. Okay. And then we gap down. And then the first hour, we're already down. The first hour and a half, we're already down. I'm already developing this trend right here. But I don't know, this is kind of cheating, but let me see if I can get a 15-minute chart. Can I get a 5-minute chart? Huh. Okay. Nice. Okay, so this is this actually a 5-minute chart? No, why does it cut off? Yeah, I guess we can't get data that far back. So unfortunately, this is the best that we can do. It's only up to 8 a.m. But okay, so I always wait the first half hour. Okay. First half hour goes by, we create this range right here. Okay. We already gapped down below the MA200 on a daily. That's making me very cautious. Okay, I need to know if we're going to get back up above the MA200. After the first hour, we break down below the opening range. Okay, and in this case, when we gap down below the MA200, we break down below the opening half-hour range. I'm going bearish. Okay, does that make sense? And then so if we do this on March 24th, we're not going to see that same story. Yeah, this is going to be very difficult to do. Let's see, March 30-minute chart, March 24th. Okay. Okay, so somewhere here is the MA200. Well, basically, we tested the MA200 again. So it's probably somewhere around here, that MA200. And so again, on this day, I see that we're gapping up and we're nearing that MA200. And then I need to know if that's going to reject or not. And chances are that it's going to reject. So I'm going to watch it. I'm going to watch it reject. And so somewhere around here, around 9 o'clock or so, I become more comfortable that we have fully rejected the MA200, assuming it's here. Maybe it was up here, maybe it was down here. I don't know exactly, okay? But it was somewhere over here. When I see it reject, just say it was right here, just for this argument's sake, okay? Over here, we're an hour and a half in, and we reject the MA200 the first time, then maybe would be okay. Again, without having all the data on the 5-minute chart, I can only guess, right? But this is a possibility of entering a put on that day. Okay, ultimately, if you didn't trade out of it down here, that would have failed. Okay, but it didn't go too far, and then it rejected again. So if you're still in this trade, based on the rules that I talked about yesterday, you could add to your trade right here. Or if you're not that advanced, then forget about it. This was your trade, and you went, and then you go short, and then you end the day significantly lower, and you're good. You're done. Okay. But this was not super high conviction. Actually, the super high conviction day was the 26th. 26. Oh, it was the 26th. Okay, so this spanned a few days. Okay, so you could have gone short on that 24th, and then Friday, the next day was complete chop, and then the 26th. Okay, right here this is the first half hour. Okay, once we break that half hour low right here, that is my chance for a put that day, and that would have paid off really big, where we ended right here, okay, on this bar. So that is the high conviction trade day. That's where you would have made a bunch of money. All right, yeah, that's what you're just looking off the play. So basically, Omar, I don't know exactly when, but I'd be looking at the days when we're near the MA 200 and we break it. Okay, that's what I would be looking for. Okay, that's it for today. Hopefully you guys are continuing to learn a whole bunch about how the market works, how to view the market, how to play the market. And again, the big reveal yesterday was that the market expects, or all of finance and all of the academics in finance expect the market to be random, but they're not. They're not always, I should say. They're not always. And so basically we're looking for times and areas in which the market does not behave randomly. And that's when we have our edge. The market is pricing in randomness. we know that it's not random. And so that gives us our edge, and that arbitrage opportunity gives us the ability to make outsized gains. Okay, and so that's exactly, everything is a variation of that. Any methodology of making money in the markets is a variation of that, except for time decay trades. Okay, time decay trades are, all right, as long as it stays here, which basically you are counting on randomness. Right? If it just stays in here and it just stays random, non-directional in here, then I make a bunch of money. Okay, so everything but a time decay trade is capitalizes on non-randomness in a place where the market expects randomness. Okay, that's it for today. I will see you guys tomorrow, and I hope you have a wonderful rest of your day.